As usual, a ton to get to, and I'm referring to this episode as the circular firing squad. I don't recall a time when every single day brought some new revelation, some game changing event that upended the macroeconomic calculus for the country and for the world. And this week was no exception. And I have a loaded report for you. But can we start off by acknowledging together how utterly bonkers this interview with Treasury Secretary Scott Bessent is? They're in Hitler's bunker, and Hitler's dead. Well, I can tell you as of this week, Himmler and Göring are dead too. The leadership has been decapitated, and contrary to what the mainstream media in the US wants you to believe, they are in chaos. They are having trouble communicating, and all these rocket launches that you see are the death throes of a dying regime. Yeah, we're going to hear a little bit more from Scott later on economic matters. But I think somebody needs to remind him that he's the Treasury Secretary. He's not the head of Homeland or the War Department. He's not the Secretary of State. Doesn't work for the CIA, the FBI, the NSC, or any of the other mass surveillance acronyms or military departments that we have. He is the Treasury Secretary. Can you imagine Janet Yellen or Tim Gittiner on a talk show talking about military strategy like a sixth grader? Mind you, I mean, Larry Summers wouldn't have either, but that's because he was busy texting Jeffrey Epstein. Anyway, the point is, every cabinet member has to trot out in front of the cameras and defend Trump's actions while he destroys the very things that these people have been charged with protecting, you know, like the US economy. So today I'm going to show you a slew of economic data points that actually tell a fascinating story, and one that you might not expect. I'll give you the last line of the story. We have crossed the economic Rubicon. We are screwed, and I'll tell you why. But the rest of the story is an economy that wants to go in another direction. And it's super tragic. Like, the economy wants to perform, the markets want to run, but this administration apparently wants nothing to do with it. I'm Max from UNFR here. With the macro, take your weekly digest of all things economic exclusively for the Midas touch. So let's go. All right, so before we get to the numbers, and there are a lot of them, I want to give you the frame because the data only makes sense if you know what you're looking at. There are basically three forces at work in the American economy right now. And think of them as three horses hitched to the same cart, except that each one is galloping in a different direction. Like, force number one is the underlying economy. So heading out of Biden's term, almost every economic metric was recovering slowly. It wasn't fast enough or profound enough to elect Kamala Harris, but it was improving across multiple sectors: job growth, wage growth, seeds, of manufacturing from the CHIPS and Science Act and the Inflation Reduction Act. So the proverbial pump was primed. Then along came the tax cuts and Doge stripping out core elements of these important growth acts, and then Liberation Day. So the underpinning of the economy, were it really brittle, these events, any one of them could have cratered the economy sooner. Point being, Donald Trump inherited an economy that wanted to grow. Now, force number two, the markets. Despite all of this, despite kidnapping a world leader, breaking with our allies, the tariff chaos, the policy whiplash, markets have continually been trying to rally because, as we've talked about, capital is always in search of a home. Even in the face of Trump's chaos, the markets, quote, looked through it because the US dollar is still considered the world's safe haven, and that someday he won't be there. Which brings us to number three. That's this administration, the horse that's galloping the furthest in the wrong direction, and it might be the strongest one. And this is where everything falls apart, because every time the economy finds its footing, every time the markets start to stabilize, there's some new executive order or a new threat, a new tariff, a new truth social post that sends the whole thing sideways. Now, something that I feel strongly about that's important to contextualize whenever we do this is not to sound hyper-artisan. I have many misgivings with prior administrations in how they've managed, especially the bottom half of the American economy. In this particular case, what's interesting is that both the economy and the financial markets have been, quote, looking through so much of this chaos for silver linings to rationalize growth to be optimistic. But I want to be clear that the bottom 50% of Americans are suffering. were suffering, and now he's made it that much worse. I mean, the last year has been absolutely punishing, especially for the lower end of the economic spectrum, but now he's pushed his luck. He has dragged us past the point of no return. And for this, we can let the numbers do the talking. Let's start with a sector that I haven't actually covered yet on Midas, but it's a super important one because it's where people feel it first, and that's housing. Because it doesn't matter what the S&P does on a Tuesday. What matters is whether you can afford a roof over your head. So not only is housing one of the most important indicators, right now it's one of the most confusing. The National Association of Home Builders Index came in at a 38, which is what the market calls a beat, better than expected, but 38 is still historically depressed, which means that builders just aren't confident. Now, pending home sales, on the other hand, rose 1.88% month over month, which was also a beat. But this was driven by modest affordability improvements, likely from the brief dip in mortgage rates earlier in the year. So you've got builders feeling lousy and buyers tentatively stepping back in. Again, mixed signals. Now, if we pull back, new home sales in January absolutely collapsed. They're down almost 18% from December and down 11% year over year. And the median home price has fallen to 400,000, which sounds like a lot, but that's down 7% from where it was a year ago. Now, you might think that falling prices are good news if you're a buyer, and it is. But here's the problem: months of supply hit 9.7. Anything above 6 months is considered oversupply, which is a buyer market. But that means that homes are just sitting there. You've got builders cutting prices because they can't move inventory as well. So all of this, mind you, is before the oil shock hits pump prices, before the latest round of tariff uncertainty. So if this is a starting line, you can only imagine where housing is headed. So now moving over to the quote unquote productive economy, the manufacturing base, here's where things get really interesting. So we've got two manufacturing surveys, big ones that came out in the same week with two completely different stories. And geographically, they're relatively close together. So the first is the Empire State Manufacturing Index. That's the New York Fed's read on factory activity in the region, and it came in negative. Whereas consensus was that it was going to be up maybe 3 to 4%, and the prior reading was over 7. So manufacturing in New York didn't just slow down based on surveys at least, it stalled. Shipments dropped almost 7 points. But here's the weird part. Capital spending surged to a multi-year high. So you've got firms investing in equipment and capacity even as their output stalls. Again, weird. So apparently they're betting on a future that they can't even see. They're spending money today, hoping it makes sense tomorrow. One of the reasons for this could be the way that the new tax policy has filtered through in manufacturing, where you get to write off equipment within a year instead of having to advertise it over time. But a lot of that activity happened last year, and this is new data. So it's a curious thing. Meanwhile, 300 miles south, the Philly Fed Manufacturing Index came in nearly double consensus. It was a blowout. Again, before we pop the champagne, we have to look at the details because there was a simultaneous increase to price inputs, which means now there's inflation pressure building at the factory level. So firms might be optimistic, but they're also signaling that costs are going to push through to you and to me. So we've got two regions, two similar ones, with two realities, and that is an economy that doesn't know what it wants. We've touched on this next one before, and it's related to everything. This is maybe one of the most astonishing reports this year. That's producer prices. Now, we covered it in a video before, but now we have the final revised numbers. And essentially, this is the inflation pipeline. This is what businesses pay before it hits your bill. So if we have factories signaling price hikes, which is before, this is what's already in the pipeline and about to hit consumers in January. The final numbers came in 0.5% month over month. Services rose 0.8%, and that was the ninth consecutive monthly increase in core services, 9 months in a row. But hang on, because when you look at new factory orders, they were up only 0.1%. That's barely positive. But unfilled orders rose 8 to 10%. That's the 18th increase in 19 months. So, what does this all mean? It means that factories have a growing backlog of orders that they can't fill, and new orders are barely trickling in. In other words, the industrial sector is just sort of running in place. Now, over to jobs. Again, a fractured picture. So, on the heels of the devastating January job losses that sent the markets reeling, the new initial jobless claims just came in at 205,000, which beat the consensus estimate of 215. But again, competing narratives because continuing claims were up 46,000, which means that those who did lose their job have been staying unemployed for longer. Now, against the backdrop of all of this really confusing and jarring data, we of course have the Federal Reserve. That was the big story this week, that Jerome Powell came out of the ground and announced there was going to be 6 more weeks of winter and are going to have to hold rates steady. Blah, blah, blah. I'll tell you this much before we get into the remarks specifically. It doesn't matter. It really doesn't matter. Stephen Meyer, of course, was the only dissenting voice saying we should bring rates lower. But if you look at the Fed's dot plot, everybody else in the Fed is kind of hawkish for the rest of the year, which means they probably don't want to decrease rates anymore because they're worried about inflation. What I will tell you, as we covered in another video from Midas as well, is that we're in this period of fiscal dominance, which means that these monetary policy moves, they actually don't matter that much. And that's why, even though it's the big thing, when the Fed chair comes out and he says, oh, rates are going to be X, Y, and Z, it doesn't matter. The markets don't even move on it anymore because rates don't move the needle in a period of fiscal dominance. And fiscal dominance means you're running extraordinary deficits and you have a really confusing economy. That's exactly where we are right now. Monetary policy does not move the needle. But I digress. Powell's statement was careful, as he always is. He said that inflation remains somewhat elevated. It flagged the Middle East as an uncertain situation. Basically, we have no idea what's about to happen. We're not going to pretend that we have any idea what's going to happen. They're stuck. The policymakers are absolutely stuck. Now, Goldman Sachs pushed their first rate forecast with their first cut from June to September because punt markets are now pricing in just one cut this year, with the rising probability of there being none. And Investopedia called it, quote, a central banker's worst nightmare. And that pretty much sums it up. They're stuck. They can't cut because inflation won't cooperate. It's kind of a dubious claim, though, because I don't think it's going to cooperate with no matter what they do. Now, they certainly can't hike because the economy would buckle, and that is definitely a fact. So they just have to sit there, and they have to hope that the guy in the Oval Office doesn't blow something else up in the meantime. Now, beneath all of this data, there is a shadow war being fought in the oil markets, and it holds all of our futures in its hands. And it's going to tell you everything about how this administration actually thinks about running an economy. So now let's go back to Scott Besson on Fox Business, because he didn't just talk about Hitler's bunker. He laid out in remarkable detail the administration's oil strategy. And I mean that literally. He went on television and described a coordinated plan to manipulate global oil supply in the middle of a military campaign. Anyway, here he is. This is a coordinated effort. We had a break the glass plan across the administration and at Treasury. We unsanctioned Russian oil. We knew that there were about 130 million barrels on the water, and we created supply that is beyond the Straits of Permouth. In essence, we will be using the Iranian barrels against the Iranians to keep the price down, for the next 10 or 14 days as we continue this campaign. WTI and its European counterpart, Brent, have substantially diverged over the past few trading sessions. They were trading right on top of each other last week. And this is because the US, thanks to President Trump, in his first term, the continuing efforts here is virtually energy independent. Okay, see if you can follow along, because I'm having trouble and I follow this stuff. The US has unsanctioned Russian oil. So there's approximately 130 million barrels of Russian crude on the water right now being directed somewhere outside of the Strait of Hormuz choke point. Now, on top of that, the administration is planning to unsanction roughly 140 million barrels of Iranian oil to, quote, use the barrels against the Iranians. So the goal is to suppress global oil prices during the military campaign. That's the framing here. And they're calling this a break glass plan and saying it was coordinated across the administration, the Treasury. They planned for all of this, and they're saying that they're not intervening into the futures markets. They're supplying the physical markets. They're flooding the world with actual crude to keep prices from spiking while bombs are falling. But let's look at the spread. WTI, that's the American benchmark, is sitting around $90 even amidst this plan. Brent, the global benchmark, is north of 108. That's a $12 spread. That's the widest since 2015. And that's important, and I'll tell you why in a minute. Oman crude, by the way, which is the benchmark for Middle Eastern oil, is topping 150. And on top of it all, they floated a US oil export ban, and for that, I give you Stephen Shaw. The bread market is now the benchmark for the seaborne trade in oil. And this is the market that is pricing the conflict, is pricing the war, is pricing the shortages that we are seeing. The WTI market prices, optionality prices, optimism. It's a landlocked contract. It's a futures contract. And like every futures contract, it dares its value from a physical asset. The physical asset in WTI is landlocked in Oklahoma. It's a different type of crude oil. Brent is a similar crude oil, but priced in Atlantic Basin barrels, and it's the benchmark for the seaborne trade. So every time we see a dovish headline, the war might be ending, or there's an off-ramp, that optimism gets priced into the Brent, the WTI contract. And that is the hope contract. The bread market is the real market that is pricing the real events going on. And that blowout in the spread that we've seen over the past week and a half tells you that this war is far from over, because we are seeing a tremendous bid in Brent over that WTI contract. Now let's be clear, an export ban would be catastrophic for US oil production, because all it would do is pent up more supply here in the United States of oil we don't necessarily use. So we don't have a use for it. So we're not going to burn it. So the inventories would just build, and as those inventories build, there's no place for new production to go. So ultimately, it's a catastrophic move. Yeah. An export ban would have cratered the US energy industry. It would have killed shale investment for sure. But it would also send a signal to global markets that America's going to close up shop and keep all of our oil for ourselves, while we just allow your energy infrastructure to be completely destroyed. Sorry. I mean, our energy secretary took that off the table on March 19th. He tweeted it out, which is apparently how we govern now, just policy by social media post. But the damage was already done. And the fact that it was even on the table spooked markets. And then the Treasury Secretary, in his infinite wisdom, said he was going to come after Iranian money, saying they were going to go claim their funds during the middle of a campaign. Just saying everything out loud that we're planning on doing. So, I'm not going to debate the merits of a military operation. I mean, that's a different show, and you've probably gotten enough of that. But I will say this. When your Treasury Secretary is simultaneously managing a war economy, unsanctioning Russian oil, weaponizing Iranian crude, tracking personal bank accounts of foreign leaders, all while the domestic economy can't figure out which way is up, and then he's commenting on actual military operations and affairs, you're watching an administration that is playing with live ammunition in a room full of bystanders. And those bystanders, by the way, are you and me. So now let's connect all of the dots, because there's a signal underneath all of this that everybody seems to miss. And it starts with something called the TIC report. It's the Treasury International Capital Report. It's something that we talk about every month here at Midas. And this tracks how money flows in and out of US financial assets from foreign investors. Think of it as like the world's report card on whether they trust us or not. So in January, total net TIC flows swung negative again, $25 billion. That's a swing of almost $140 billion from December, where we had $13 billion coming in. Although, as we've been pointing out for almost a year now, We're losing ground on treasuries and we're picking it up on equities. So less investment into the US Treasury, more investment into our stock market. Because again, capital needs to find a home. And it's not betting in us, it's betting on our corporations to get ahead. This is why the Sell America narrative has become a vital narrative to understand at this point. It's coming true. So as of this report, foreigners shed another 10 billion in T-bills and bank dollar liabilities from foreigners dropped tight $58 billion. Meanwhile, Americans were buying $47 billion in foreign securities. These are huge outflows. Money basically looking for the exit. Now, it's not a stampede, but again, this is January's figures. This is before we started another freaking war. Now, to finish these thoughts, let's move away from liquid gold and talk about actual gold because that's been a huge story over this last year. Gold hit an all-time high earlier this month at 55.89 an ounce, and then it reversed about 6% from the intraday high when the Iran conflict triggered a safe haven bid for the dollar. So the initial spike on the Hormuz news took it from 5,200 to 5,400, but then it pulled back as the dollar strengthened. See, a strengthening dollar is yet another metric that will soak complete chaos into the economy, which I'll explain more in a second. So currently the dollar index is sitting at about 99.6, and that's up 2% over the last month on the war premium, but it's down 4 and 84% over the last 12 months. Now that 12-month number is the one that matters because it tells you the structural trend. The world is slowly, quietly diversifying away from dollar dominance. And here's the trap. A strong dollar, which is what we're getting right now for this war premium, directly undermines Trump's own trade strategy. So if you want to boost exports, if you want tariffs to make foreign goods expensive and domestic goods competitive, you need a weak dollar. A strong dollar makes American exports more expensive abroad and makes imports cheaper. So it's exactly the opposite of what the tariff policy is supposed to achieve. Meanwhile, the yuan moved 1.6% to 7.3 against the dollar in mid-March. And that tells you that China isn't panicking, it's positioning. They're just adjusting, and that should tell you something about who has a plan and who's just making it up as they go along. Alright, I know I threw a lot at you today, but let's wrap it all up and bring it home because I promised you a diagnosis and the data has pretty much written it, prescription for us. So bottom line, the economy wants to perform. I mean, look at the Philly Fed, right? Look at the capital spending in New York even. Look at the jobless claims. There's muscle in this economy. There is capacity, there's willingness. The markets also want to run because look how quickly they rally on any shred of good news. Look at how capital keeps coming back to the table after every sell-off. See, investors aren't bearish by nature, they're being made bearish by circumstance. And the administration says it wants growth. It says it wants energy dominance. It says it wants manufacturing back on American soil. It says it wants to renegotiate trade on better terms. And yet we have new home sales collapsing, and the administration then responding with more policy uncertainty. The Fed totally paralyzed, and the White House keeps piling on this inflationary pressure with tariffs and supply disruptions. Private foreign capital is heading for the door, and the response is to unsanction Russian oil and weaponize Iranian crude in a 10-day gambit that has no plan for day 15. If the dollar strengthens on the war premium, then it directly undermines the president's own trade agenda. An export ban gets floated and killed by a tweet in the same week. This is a circular firing squad. Now, one thing that I want to reiterate is that these are not partisan observations. These are empirical observations, right? I mean, you can look at every single data point that we covered today. Housing, manufacturing, inflation, jobs, the Fed, the tick flows, the dollar, gold, oil. In every case, the variable that's introducing chaos, contradicting the underlying momentum and creating paralysis isn't the economy. And it's not the Fed. It's not even the markets. It's the policy. Actually, it's the man making the policy. It's Donald Trump. Trump is the fly in the ointment. He's the stick in the spokes. The reason capital is nervous, the reason that the Fed can't move, the reason builders are sitting on unsold homes, the reason that businesses are afraid to restock their shelves. It's not because the economy is fundamentally broken, it's because the economy can't get a clear signal from the people who are supposed to be leading it. I mean, Scott Bessant, the Treasury Secretary, is talking about Hitler's bunker. So the data are pretty clear. It's the economy that isn't, because the president is running it. All right, that's it for us this week. Make sure to like and subscribe to Midas Touch to be notified of any new drops. You can also sign up for my free weekly newsletter at unfr.com. And while you're on the site, make sure to peruse our directory of progressive resources, our original essays, and links to our podcast. You can find me on YouTube and Blue Sky at UNFR as well. So, I hope to see you there. This is the macro take exclusively for the Midas Touch Network, and I'll catch you online. Want to stay plugged in? Become a subscriber to our Substack at midasplus.com. You'll get daily recaps from Ron Filkowski, ad-free episodes of our podcast, and more exclusive content only available at midasplus.com.